Welcome back to Part 2. If you just finished Part 1, you're already furious about how broken the housing market is. Good. Hold on to that anger. We're going to channel it into actual action. If you're jumping straight into Part 2 without watching Part 1, pause right here. Seriously, go back and watch Part 1 first, where I break down exactly why housing is so unaffordable and who's to blame. This will make way more sense if you have that context. All right, let's get to it. Last month, I saw two posts back-to-back on Twitter. First post, a 26-year-old celebrating buying their first home with a picture of their keys. Cute, right? Second post, literally 3 tweets down, a 28-year-old saying they just got priced out of their rental because the landlord raised rent by $600. Both Gen Z, both working full-time, completely different universes. That's what we need to talk about. We need to have an honest conversation about privilege and the wealth gap within Gen Z, because it's not all the same experience. Who is buying homes in their 20s and early 30s? According to the National Association of Realtors, 24% of first-time buyers get down payment assistance from family. That number is probably higher for younger buyers. Some estimates put it closer to 40% for buyers under 30. And we're not talking about small amounts here. The average family contribution for a down payment is around $30,000 to $50,000. In expensive markets like California or New York, it can be $100,000 or more. I'm not judging anyone who gets help from their parents. If your family can help and wants to, that's great. Use that advantage. But we need to acknowledge this is creating a widening gap between people with generational wealth and people without it. If your parents can gift you $50,000 for a down payment, your path is completely different than someone whose parents are struggling themselves. You can buy sooner, build equity faster, and you're not throwing away thousands on rent while you save. That head start compounds over decades. This breaks down along racial lines we can't ignore. Due to historical discrimination, redlining, predatory lending, discriminatory appraisals, there's a massive racial wealth gap. The median white family has about 8 times the wealth of the median black family and 5 times the wealth of the median Latino family. Much of that wealth is stored in home equity. Let me put specific numbers on this. According to the Federal Reserve, the median white family has a net worth of about $188,000. The median black family, around $24,000. For Latino families, it's about $36,000. And here's the thing, home ownership is the primary wealth-building tool for most American families. About 65% of a typical family's wealth is in their home. So if your grandparents couldn't buy a house in the 1950s and 60s because of racist housing policies like redlining, where banks literally drew red lines around black neighborhoods and refused to give mortgages there, they couldn't build that equity. Your parents inherited less wealth, and now you have less help with a down payment. It compounds across generations. Meanwhile, white families who bought homes in those same decades saw their property values increase dramatically. They built equity, borrowed against it, helped their kids with college, helped with down payments. That advantage cascades down through the generations. The home ownership rate for people under 35 has plummeted from 44% in 1980 to around 37% today. But that average hides a bigger story. For young white adults, the home ownership rate is around 44%. For young black adults, it's around 18%. For young Latino adults, it's about 28%. These gaps are actually wider than they were before the Fair Housing Act of 1968. We're creating a generation of permanent renters. No equity building, no asset to pass down to your kids, just paying someone else's mortgage forever. And this pattern is hitting communities of color the hardest. That's why individual solutions, while helpful, can't be the only answer. We also need policy changes, which I know is frustrating because policy moves slowly and you need a house now, but it's the truth. All right, I know this has been heavy. Let's talk about what you can actually control. Disclaimer, I'm not a financial advisor. This isn't financial advice. Talk to an actual professional before making major financial decisions. Strategy 1. House hacking. If you can scrape together a down payment for a multi-unit property, live in one unit, and rent out the others, your tenants literally pay your mortgage while you build equity. Here's how the math works. Let's say you buy a duplex for $300,000 with an FHA loan. 3.5% down, That's $10,500. You live in one unit, rent out the other for $1,500 a month. Your total mortgage payment might be $2,000 a month, including taxes and insurance. Your tenant is covering $1,500 of that. You're only paying $500 out of pocket for housing while building equity in a $300,000 asset. Compare that to renting a one-bedroom apartment for $1,500 a month where you build zero equity. FHA loans let you put down as little as 3.5% on properties up to 4 units if you'll live in one. That's way more accessible than the conventional 20% down payment. The catch? You need to live there for at least a year. And being a landlord is work. You're dealing with tenant issues, maintenance, all of that. But financially, it's one of the fastest ways to build wealth if you can handle it. Strategy 2. Non-traditional markets. Not everyone needs to live in San Francisco or New York. There are cities with good jobs, culture, and quality of life where you can actually afford a house. Pittsburgh, Cleveland, Detroit, parts of the South and Midwest. Homes for $150,000 to $250,000. That's a $30,000 to $50,000 down payment with 20% down, or as little as $5,000 to $9,000 with an FHA loan. Let's compare. The median home price in Austin is around $550,000. In Pittsburgh, it's around $220,000. Same job at the same salary, remote, but in Pittsburgh, you could actually afford to buy. And these aren't dead cities. Pittsburgh has a growing tech scene, world-class universities, culture, sports teams. Cleveland's seen a renaissance. Detroit is rebuilding with young people moving in specifically because of affordability. With remote work still being a thing post-pandemic, this is more feasible than ever. Not every job is remote, I know, but if yours is, or if you can find work in a lower-cost city, you don't have to stay in the expensive city. The trade-off is you might have fewer job options if you need to switch careers, potentially less cultural diversity, and you're farther from family if they're in expensive cities. These are real considerations. But from a pure housing affordability standpoint, this can be a game changer. Strategy 3. First-time buyer programs. Most states and many cities offer first-time home buyer programs with down payment assistance, lower interest rates, or reduced closing costs. For example, many states have programs that will give you 3 to 5% of the purchase price as a grant or forgivable loan for your down payment. Some programs offer below-market interest rates, some will cover closing costs. In California, there's the Cal HFA My Home Assistance Program, 3.5% down payment assistance. In New York, the State of New York Mortgage Agency offers down payment assistance and competitive rates. Texas has the My First Texas Home program. These exist in almost every state. Research your specific area. These programs exist, and many people don't know about them. Your local housing authority or a good mortgage broker can tell you what's available. Also, first-time buyer usually means hasn't owned a home in the last 3 years, so even if you've owned before, you might qualify. The catch is these programs often have income limits and purchase price limits. You need to make under a certain amount and buy under a certain price. But for many people, these programs are the difference between buying and not buying. Strategy 4. Build your credit and save aggressively. I know, groundbreaking advice, but seriously, a good credit score can save you tens of thousands in interest over a mortgage's life. Here's the actual math. On a $300,000 mortgage at 7% interest over 30 years, you'll pay about $418,000 in interest. That's over $700,000 total. If you have excellent credit and get 6.5% instead, you'll pay about $383,000 in interest. That's $35,000 in savings just from having better credit. If you can get it down to 6%, you're paying about $348,000 in interest, a $70,000 savings compared to 7%. So, how do you build credit? Pay every bill on time, every time. Keep credit card balances low, ideally under 30% of your limit, but under 10% is even better. Don't close old credit cards because length of credit history matters. Don't apply for a bunch of new credit at once. If you don't have credit, get a secured credit card. You put down a deposit, they give you a card with that limit, you use it and pay it off every month. After 6 to 12 months of on-time payments, you've started building credit history. On the savings side, automate it. Set up automatic transfers the day after you get paid. Even $100 a month is $1,200 a year, $6,000 in 5 years. That's not enough for a down payment in an expensive market, but it's a start. $300 a month is $3,600 a year, $18,000 in 5 years. In a lower-cost market, that could be your FHA down payment. Having even a small emergency fund means you won't go into debt when your car breaks down or you have a medical bill, which means more money available for a down payment eventually. I know, just save more is privileged advice when wages are stagnant and everything costs more. But if there's any room in your budget, automate it so you're not relying on willpower. Strategy 5. Consider alternative arrangements. Buying with friends or family members. You can combine your down payment money and buy a property together. Yes, this is legally complex and you need a solid agreement in writing, but it can work. Co-op housing in some cities. You buy shares in a corporation that owns the building rather than buying the unit itself. These are often cheaper than condos. Manufactured homes. Modern manufactured homes are not the trailer parks of decades past. They can be nice, affordable, and you can own the home even if you're renting the land it sits on. Condos instead of single-family houses. Generally cheaper, less maintenance since the HOA handles exterior stuff. You're building equity even if it's not the suburban dream. Townhouses, duplexes, anything that gets you in the door of ownership. But here's the real talk. For some of you, home ownership might not happen in your 20s or even your 30s. And that's not a personal failure. It's a systemic reality. Renting isn't throwing money away. You're paying for housing, which you need. It provides flexibility. You can move for job opportunities. Someone else deals with maintenance and repairs. If the roof needs replacing, that's not your $15,000 problem. The problem is when renting is your only option, not by choice, but because the system has priced you out. That's what we're fighting to change. So, here's what I want you to take away from this. You're not crazy. Housing is genuinely unaffordable in a way it hasn't been for previous generations. It's not your fault. Structural economic changes made this happen. But there are still things you can do to improve your situation, even if the system is rigged. And we need both individual action and collective political action to fix this. Vote for candidates who support affordable housing policies. Support zoning reform in your city. Show up to city council meetings about housing development. The system won't change unless we change it. Look, the system is rigged, but that doesn't mean we can't beat it at its own game. Every week, I'm exposing another broken financial system and giving you the actual strategies to win anyway. So, subscribe and turn on notifications. You don't want to miss this. If this video helped you understand what you're really up against, share it with someone else who needs to hear it. We're all figuring this out together, one broken system at a time. See you in the next one.